And so here's this. Okay, so this is the different approaches to money management, right? And so what you'll see is you have two sides. You have what banks do, and then what they tell us to do. And as you'll see, they're very different, right? And so so banks, they do a couple of things. So if you don't know, banks make money by they take our money, they leverage, right? They take what we have in our savings account, right? And we talked about earlier about fiat currency. Well, this is part of it. So even though you look into your savings account, you might see $10,000 in there, but that $10,000, the bank is putting it to work. Okay. So what that means is that they are taking that same 10,000 that's in your savings account and they loaning it out at a higher interest rate and paying you maybe about less than a 1%. And they make that spread, right? So and that's what we call velocity of money, right? Their money is never sitting. So when you think about banks, if you have to think about this, like banks were created to literally, like, they have no purpose, they're not mission based. Like, most businesses exist to solve a problem, not banks, right? They simply are intermediaries, right? They're not solving, like, they're just in the middle. They pretty much say, here's a new branch, bring me your money, and when we deposit our money into the account, they're then able to make loans and do all the things, right? That's velocity of money. Banks don't put their own money into their bank to start, right? They get us to do it, right? And so they leverage our dollars essentially, right, to make more money. And so that's the biggest difference between what banks do and what they tell us to do. Meanwhile, we're told to save for retirement, pay off debt, buy term and invest the difference, over diversify with mutual funds, right? And so these are the huge differences in which I believe that keeps us, status quo, right? I've learned early on in my wealth journey that there's two schools of thought. And one is, if you're wealthy, this is what the wealthy do. And if you're not wealthy, this is what you do. You pay off debt. Debt is bad. You don't leverage debt. And it makes sense, right? You have the Susie Ormans and Dave Ramsey. I followed Dave Ramsey at one point in time. I had bad credit card debt. I had a bad relationship with money as it relates to credit card debt, and credit, not understanding how to leverage it to buy assets. And so that advice worked for me, right? I had a really bad relationship with credit. And so Dave Ramsey, using cash to pay for things worked. But as I, progressed in my wealth journey and decided, okay, I don't want to forever be in my 9 to 5, right? I want to, and this was years ago, right? When I started to change my mindset around money, I realized if I wanted to be wealthy, and I'm talking about Rockefeller wealthy, right? How do I do that? I need to do what wealthy people do. And so discovering infinite banking, which is what a little bit of what this is about, just understanding what banks do, how they make money, I said, okay, this is what I need to copy. And so this is just highlighting the differences between what banks are doing and what we're told to do. Totally two different worlds. Next slide.
So, you said something earlier, that I wanted to touch on, which is
Hmm.
is the banks, they use our money, right? And what I've seen and what I've heard from other folks in my circle where they went to withdraw $25,000 from a bank, they didn't have it in cash. They couldn't give it to you in that
Oh,
in that moment. They had to now say, hey, come back in a day, come back tomorrow, come back in 3 days, just to get your money, because they don't carry that kind of money on a regular basis.
yes. That was me,
So
by the way. Yes, I'm glad you brought that up. I forgot about that. So yes, I had a deal. I was transferring money on a real estate deal, and I needed my money because I had a new account with. I won't. The bank will remain nameless, but because it was a business account and I had it for like under whatever the required time it was, they told me I couldn't do transfers. Like, I didn't have I could not do a transfer from my online account to transfer my money to my partner. And so I said, fine, no problem. I'll just go into the bank. Well, when I went into the bank, I said I need to pull out the $25,000. They was like, you know what? We could speak to the director, and they approved my transfer because they did not have the money in their vault. They could not give it to me in my hand. And so here we are with the fiat currency. So thank you, Chris. I forgot about that. Yes. Um,
and we
yeah,
also
just
you also said something about the Federal Reserve. For most people, I think they believe the Federal Reserve is actually a federal institution. And in my research and in the research you've done, we realized that it's not a federal entity. It was created by I believe it was the Rockefellers
Mm.
who wanted to control the flow of money and how it was done. So, uh, if you didn't know that, now you know
Yeah.
that it's not federally owned. It is a private institution.
Yeah, controlled by banks. It represents the bank's interest. So I'm glad, yeah.
It
Like
does.
and you gotta recognize JP Morgan, right? Chase and JP Rockefeller, they didn't want their money to be tied up in Congress. I kind of get it. And you gotta recognize like that's kind of as the kids would say, that's kind of gangster, right? When you have money like that you could create
A
like an
bank for the
entity,
world.
right? And if you and that's why I mean they've never produced an audit. No one knows what's happening, right? And not only that, if you look at who's on the board, of course the top one is Citigroup. This was as of 2017, I think. And JP Morgan Chase Bank is the second largest shareholder of the Federal Reserve. And what people don't realize, they represent commercial banks. Like, who are the wealthy people? Just think about it. JP Morgan and Rockefeller at the time was just one person, right? But it's no, of course JP Morgan created this bank, and so they represent wealthy people. Banks are wealthy. They like have money just coming to them. That's what we do when we put our money in deposit. It's synonymous, right? And so as I said before in the previous slide, like we're taught to put our money into mutual funds, right? And so I got this quote from a book called Pirates in Manhattan. Barry Dyke is very detailed, but in the book he talks about, I've never met a man, this is his quote, I never met a man who made his millions in mutual funds. And so you got to think about that, right, for a second. And it says here, I read the quote. This quote is from the Motley Fool, and it says the sad truth of the matter is that over time, the vast majority, approximately 80% of mutual funds underperform the overall stock market, right? And so a lot of times, and it's not to say like don't invest in the stock market. Stock market is great, but you want to make sure what you're invested in, because obviously mutual funds don't. I don't think people recognize that mutual funds don't make money. And furthermore, I always use this example of Warren Buffett. Warren Buffett, hands down, would you guys agree, is like the greatest investor of our generation. And Berkshire Hathaway, I have yet to see a mutual fund company that they buy. They buy things that they understand. Buffett is no, he's not like romanticized or making it sexy about how what he invests in. He'll tell you, I invest in things that I understand. If I don't understand it, I don't invest in it, right? And so here you have Warren Buffett, who has, by the way, more money than the US government, right? He has more cash than the US Treasury right now. And so here you have a man who, as I said, show me a mutual fund company. Now I say mutual fund, meaning the stock, not a life insurance company, but mutual fund company that they buy. They don't, right? He's wealthy, and you never hear people say, "Oh, I made my millions in a mutual fund." You might meet people who made. I know, I have a mentor who made millions. Is like filthy rich or wealthy from the stock market, right? But not in mutual funds. But most 9 to 5ers, we put our money in 401ks, which are comprised of mutual funds, unfortunately. So, next slide.
So, and just to touch on something you said about Warren Buffett, right? One of the things he said as well is buy things that you know, buy things that you use, right? So
Yep.
all the things that you have in your house that you continually reinvest or repurchase or upgrade on, you want to buy those companies. Those are the companies you want to own stock in. So I think it's very important to recognize that.
Mm-hmm. Yep. Success leaves clues.
Right. And so becoming your own banker. This is a must read for anyone who wants to create your own banking system, right? So if you're interested in creating your own banking system, you got to read Nelson Nash's book, Becoming Your Own Banker. It's a requirement. It's not a long book. It is very short, but it is very, very insightful, and it lays out the philosophy and the strategies that is the cornerstone of this saving strategy needed to understand what it takes to create your own family bank for or in the infinite banking concept.